Hello, everyone, and welcome to Pod TV's number one TV show, Wall Street Hackers, with your host, Peter Bennett, who earned his bachelor's in economics at UCLA, obtained his law degree from the University of Miami, and his MBA in finance from New York University, where he continued to trade on Wall Street for the next 17 years. Peter is bringing to us some of his knowledge and sharing a wealth of information so that we can also become Wall Street hackers. Everyone, welcome, Peter Bennett.
Hey, Kim.
Hi, Peter.
Everybody. So we'll begin with the markets, as always. The Fed, as expected by almost everybody by the time we got there, raised a quarter point. But some are saying, oh, the banking crisis is going to lead to all these delusional things in Wall Street hackers' mind. In other words, the end of the bear market. It's going to lead to the Federal Reserve stopping increasing interest rates. It's going to lead to the Fed actually lowering interest rates and a soft landing. The market is actually pricing in a reduction in rates by the end of the year. Now, that is the same kind of delusional thinking that has occurred for about 15 months. The market keeps thinking, oh, everything's going to be great and it's all going to work out, no recession. But if there is a recession, we know that the average market goes down 35%, and there's a lot of danger for that in reality. So the first piece of evidence is what's called the Fed dot plot. And I haven't discussed this on the show yet, but basically they plot where the different Fed officials expect rates to go, the target Fed rate. Right now, it's 475 to 5. So if you look at the dot plot of the 18 Fed officials who go into it, only one of those 18 have it below 5%, and it's only slightly below 5. It's at, I think, 4.9. So that's not a drop, really. But the median is 5.1%, slightly higher, but many think it could go as high as 5.8%. So the Fed officials themselves don't expect a drop in rates. If anything, they expect an increase. But again, the market thinks everything will work out and the Fed is wrong. Well, let's look at where the Fed's been wrong in reality. The Fed has been wrong all along for the last over a year because they keep thinking it's all under control and we can stop. And the market just eats it up and goes further. But the Fed has been underestimating what they need to do to fight inflation. And there's very little sign that they've had any progress at all. I'm looking for the signs. I'm hoping we'll get to the top. Everything will work out, because it hurts a lot of investment opportunities. So, but you have to be more particular than ever, obviously, in what you do pick. But inflation rages out of control, as it has. And there's so little evidence of a change. Now, the housing market we've always said is the first one that's going to reverse and go down. Well, finally, there was some evidence of a decline. In the second half of 22, housing prices were just reported to have fallen 4.9%, which is a start to the decline of housing prices. But first of all, the market was up in 22 totally 8.4%. So that's less than half a year of the growth, including the 4.4 in 22, that part. So in the end, in 22, the market went up anyway, but it is starting to reverse. And it's expected with mortgage rates this high, it will go up. Housing prices are going to go down, and we saw an incremental drop last month's report, but it's small again, down down about 1%. So after huge increases, it's just starting to turn, and it's going to take a while. We have a housing market that's basically locked between buyers and sellers. So not a lot of sellers a lot of people don't want to move now because they'd have to take a mortgage with higher rates. So there's not a lot of demand to sell. A lot of supply by sellers. But on the other side, people can afford less and less. So it's going to move slowly, but I wouldn't be surprised if we ultimately see a decline of 15 to 20%. Everything else, though, and this one's just turning, the other four factors that we've been talking about for over a year, almost no progress at all. The Fed is, there's a stimulus out there by the federal government, and there's not a lot that they're doing to decrease it. It isn't as stimulative as it was, but the government keeps spending and spending. We have gridlock in Washington, and I don't expect any relief there. A key point is, based on 50 to 70 years of history, study after study shows that the Fed has to be above the inflation rate in order to impact inflation. And there's logical reasons why that is. That could take 5 minutes to explain, so I won't do it now. But basically, with the Fed target rate at 4.75 to 5, but inflation's at 6, 7.7, I personally think it's going to go right back up again. The last one was lower around 6 because oil prices and energy prices were down a lot. I think that's very temporary. That gets us to energy, the bull in the china shop. So yes, we had a warm winter, much warmer than expected in many areas, including the United States. And we also had a temporary slowdown and or shutdown, as you want to call it, partial shutdown in China. So yes, that also affected energy, of course. These things are changing. China seems to be reopening. There's a lot of evidence of it now, and they're going to reopen. And the demand for their energy is going to just keep increasing. Weather, I wouldn't bet against it, but I'm saying we're probably going to have average weather in the future. And we're heading into driving season in the United States and many other countries. And so I wouldn't be surprised if oil shoots up a lot by this summer. So there's no, and one last point about energy, the long-term prognostication has to be that it's going much higher, because oil companies and gas companies have been underinvesting by 40% in order to maintain the supplies where they are now. There's going to be a shortfall. Demand is not decreasing like that. So we're probably going to have a big energy crisis, but that's not any signs of relieving inflation, and we're out of this inflationary mess. And finally, unemployment, again this week, every week, almost every week for 15 months, unemployment and employment show no signs of easing inflation. As a matter of fact, unemployment claims came in under 200,000 again this last report, when it was forecast to be higher. So where's the relief? There's a movie called Something's Gotta Give, which was a decent movie with Jack Nicholson. And that's a great expression. Something's got to give. Something in the economy has to happen for inflation to get under control. Now, it could be the banking crisis. I don't think it will be. I think that will be just another diversion. But it could be the banking crisis will trigger a recession, or something else will trigger a recession. But it's almost certain we're going to have a recession. Based on 50 to 70 years of history, every time inflation gets over 4%, a recession is the only thing that slows it down. So I don't know how the Fed, or the markets for that matter, can miss 50 to 70 years of history, or maybe they know it and they're just speaking, the Fed trying to keep everybody calm. But if they talk a tougher talk, maybe people would realize where we're heading and we get there faster. So it's probably a very slow walk, but we're probably heading the wrong way in terms of the market, in terms of inflation, and you have to be very cautious, obviously. So 2 quotes of the week, and I only have 2, but they say exactly the point. And these are not people to be underestimated. First, the chief equity strategist at Morgan Stanley said, the turmoil in the banking sector is likely to bring, quote, a vicious start to the end of the bear market. He said specifically, the last part of the bear can be vicious and highly uncorrelated. Prices fall sharply via an equity risk premium that is very hard to prevent or defend in one's portfolio. Sorry. So he said, to finish again, so he said that the equity risk premium and the fall is very hard to prevent or defend in one's portfolio. Well, yes, of course, that's what happens in recessions, and the market probably, based on that, has a history of resisting it. So, it's not going to happen. It's not going to happen. Boom, the bear market hits. So, never a guarantee, but it doesn't look good, and it could be very dangerous for the investor who's not positioned well. Then, also, the second quote is from Stephanie Pomboy of Macro Mavens. I really respect her. I've seen her a lot over the years on television and read things she's written. Very bright. So here's what she said. She was saying that Fed hikes are going to trigger a downturn of greater speed and magnitude than the Great Recession. She's talking about 2008, by the way, which was a bad one, but it wasn't like the Depression. But still. So she said, quote, "It's not going to be confined to real estate. It's not going to be confined to the banks. It's not going to be confined to corporate credit. This is really like 2007, 2008 all over again, except I think it's going to evolve even faster than it did then because of the speed and magnitude of the Fed's rate hikes." So basically, she's agreeing with Morgan Stanley in a way that it could happen very fast. So everything's great because of the delusion. If the market realizes the delusion is a delusion, it could tank. So we don't know that it will, anything can happen, but you have to be very defensive. And, we'll cover that again in what to do section, which we always do in the second half. So most interesting stories of the week. Fairway Grocers in New York City just implemented facial recognition, including eye scans, to detect who thieves are. This is getting to be more and more popular with retail theft around the country increasing. It's the wave of the future. More and more stores will be using it in decades to come. Probably everybody will be using it. New York City retail thefts, by the way, jumped 45% in 2022. Brilliant, policies on bail there. But here's the interesting thing I read, that only 327 thieves made up of 30% of total arrests. Again, I'll say that 327 thieves resulted in 30% of all the arrests in New York City. Maybe you shouldn't keep letting the same people out if they're creating 30% of the total arrests. So the police could maybe concentrate on the other people and preventing crime. Another story, for the first time, more Democrats now say they have sympathy for Palestinian cause than the Israeli cause. Democrats now prefer the Palestinian cause 49% to 38%. Republicans, on the other hand, support Israeli causes 78% to 11%. Totally divided country. Thank you, mainstream media and media. Don't go with the truth. Just go with your side or the other side so that you just keep getting ratings. Foot Locker said it's closing 400 of its underperforming stores in malls by 2026. They're moving to open concept stores and retail stores that are freestanding. And basically, Wall Street Hackers has felt this a long time and said, stay away from malls. If things get tight, and as tight as we expect, malls are not going to do very well. And especially compared to open air shopping centers, where there you have ongoing demand pull from grocers and maybe Walmarts and other popular stores. So those will hold up much better in almost any environment anyway. In international news, France just raised the age of retirement from 32 to 34, and Emmanuel Macron did it using an administrative procedure because the parliament wouldn't go along with it. And the main point here is it's so easy to print money, but it's hard to tell people that you can't print enough money without doing damage to the future or to the current situation. So the French people are in protest, and a lot of people are upset by this. It was probably the right thing to do. You can't print money forever, as the world's going to discover in the future. More about that later. So a top Ukrainian advisor, if we could pull up the slide of Vladimir Putin, and top Ukrainian advisor talked about rumors that Vladimir Putin sent a double to visit Ukraine. And there have been rumors for years about Vladimir Putin using doubles. I look at this and I say, yeah, I think it's a double. They highlighted the chin, but also I look at the nose, and that does not look like the same person. Now, I do understand it to a point, especially a trip to Ukraine, where it could be more dangerous, and he may have seen the risk. But it's interesting that he's using doubles, I think, and it does not look like him for sure. If we could close that slide. In other news, there's been a very large increase in Chinese immigrants coming over the Mexican border. And it's crazy. They're just letting everybody in, terrorists, fentanyl, everything. It's maybe the craziest policy I've ever seen in my life. I mean, you could argue whether Vietnam was good or bad. People had strong opinions, but this is just like, okay, open the border, terrorists come in, fentanyl comes in, you're supporting drugs, cartels. Nobody wants to do anything. It's not like where we shouldn't have legal immigration or controlled immigration like every other country in the world. I believe it's every other one. Canada certainly does. Australia does. I mean, they're very tight. They have very tight rules. But in the United States, sure, you might be a terrorist, but come on over. So in 1 week, recently, I think it was last week, the Border Patrol arrested 90 Chinese immigrants. So it's freestyle, come on in, no problem, no control. Another story, why Mean Girls are so popular. A study at Oklahoma State University of 1,183 people in the United States and India, of both men and women, said that people like friendly people and gentle people, but sometimes people prefer friends who are very vicious, and vicious to their enemies, that is. And one theory of all those people who preferred friends who are vicious to their enemies is that it creates a defensive umbrella for the group, or some other defensive emotion that people like to be next to. So it's interesting. Mean Girls make sense in a way why they're popular within their groups anyway. And finally, I think this was amazing. On March 28th, in just a few days, at sunset, 5 planets are going to be in an alignment. And that is very rare. As a matter of fact, it won't happen again until 2040. So I'm hoping we have good weather, and I'm looking forward to seeing that. That should be amazing. 5 planets in a line. So we'll take a quick break, and then we'll talk about what to do, dividend stock of the week, and a panel discussion. See you soon. Okay, what to do segment. Number one, I would say you have to own energy. Our portfolio now is about 25% energy. Last year was 29% energy. It was the only group that had a very large positive return, or any positive return. It outperformed every other group, only energy and commodities. And I think it's going to be the same going forward for a long time. So the other thing is to own defensive stocks. Here's a really interesting study by Morningstar. It recently came out with a study that said investors tend to underperform the market. And it is especially true in volatile sectors like energy and technology. Why is that? Because they tend to buy at the wrong time and sell at the wrong time. So during the study period, they looked at energy and tech sectors because they were the most volatile. And they said that during that period, the sectors earned 13.8% if you just bought and hold, but investors' returns was only 9.6%. So it was about 2/3 of what a buy and hold investor would have been. And this is why, another reason why Wall Street Hackers loves dividend stocks. If somebody has a stock and they view it as a stream of income rather than something that goes up and down in price, just like a business, by the way, if you own a dry cleaner, you don't sell it or buy it based on, or a pizza parlor or whatever, a business, you don't buy it and sell it every day or price it. If it's a stream of income, you hold it. So this, I think, helps the stock investors hold their assets longer and not be forced to sell or have pressure to sell. And dividend stocks generally perform under most periods better anyway, especially if you have the right picks. So the dividend stock of the week, of course, we love energy and especially pipelines. Why pipelines? Number one, they're in our view, the safest industry with a high yield, or maybe the safest industry period, because it's demand pull. So prices of energy go up and down, and they can affect to a point some of the pipelines, but mostly there's demand. So if somebody needs oil or gas, whether the price goes up or down of the commodity, they're still going to be shipping it. So as long as I'm heating my home with natural gas or driving, there's going to be fees paid through those tolls, and they're generally long-term contracts too. So a lot of these contracts might be 5-10 years. There might be fixed rates or have inflation factors built in. So I love the pipelines. I think it's the only sector, and that's why a good part of that 25% in energy is all in different pipelines. So the only disadvantages is, number one, you do get a K1, which can raise your accounting fees. Some of the smaller ones I just keep in the IRA to avoid that. But there's also UBTI, which is, you'll have to look that up if you don't know what it is. But basically, if you own a lot of pipelines in an IRA or 401k, you can be taxed on that. There's a penalty tax. So you can't really earn more than $1,000 in any specific IRA. But the bottom line is there's also huge tax advantages because there's depletion, depreciation, and return of capital. So you might get that yield for a long time without paying any tax on the money at all until you get all your principal back plus more, very potentially. So the pick of the day is EPD, Enterprise Product Partners, 3% allocation, which was raised recently. When we sold USAC, we went into 3% ET and 3% EPD. They're similar in many ways to ET, 7.8% yield right now. The cash flow is 6.94 price over cash flow. So if you reverse that, you get the cash flow yield, which is 14%. It's yielding cash flow of 14%, and that's including the projects that are being built. So this is why I love pipelines. The earnings per share, according to TD Ameritrade, has grown at 13.8% annualized per year. Revenue, 14.7% annualized over the last 5 years. The dividend has grown at only 2.4%, which is lower than some of the others that I like, but it's the most conservative pipeline in many people's opinion. Their debt to asset ratio is low at 0.42. And so, you know what? I'll take an almost 8% dividend with 2.5% growth. That means 10% more in 4 years, and compounding. So I'll stay with that. I mean, I don't know where anybody's going anywhere else to get that kind of safety and yield. So, there's always risk, we have to disclose that, but that's where it's another, I think, good pick, EPD. So, and next week we'll be going back to the series on international dividend payers that we view as safe. So, now discussion of the week. The question is, do financials, and in particular banks and insurance companies, make sense as medium and long-term stock investments at this time, or any time, but especially at this time? So a little background first. As you know, Wall Street Hackers is predicting certain events in the macro picture, which are very important in terms of understanding where to invest at all. So number one, we're forecasting the inflation fight will go on much longer than expected. Rates will stay higher. They won't drop this year, almost certainly. And a recession will almost certainly occur that will be very harmful to stocks when the market realizes that it's going to occur. And it may take longer because the Fed's moving slow and they keep messaging slowly, but I think it's going to happen. But in the medium and the long term, the other forecast we have in the macro is almost the reverse in a way, because I think interest rates are almost certain, maybe even certain, but you can never say certain, but almost certain to go to zero. Why is that? One, the federal government in the United States and other countries has massive debt. Everybody sees the debt clock and go to debtclock.org. It's incredible how that thing just goes up and up, 31 trillion on the books. But the off the books, unfunded liabilities for Medicare and Social Security are gigantic. I mean, you can barely fathom them. And that's true in other countries too, because they have not funded, and all around the world, US, outside the US, Europe, Asia, South America, a lot of unfunded liabilities and pensions and healthcare plans and systems that have promised free healthcare for a very aging population, which is going to draw a lot of money out of the governments. So there's going to be massive money printing. Governments are going to need rates to be zero or very close to zero, or maybe negative rates as we've had, because they're not going to be able to pay interest on the money. And they can control it using something called yield curve control, which has been done in Japan in the last 20 years. The United States did it in World War II. And it's, you can look that up, but basically that's the way they're going to control it. So if you forget the logic, the other thing you can look at is just pull up a 40-year trend line on the 30-year Treasury or the 20-year Treasury. Not only has it been going down, it's almost a straight line. It doesn't even have any bends in the curve. It's just straight down for 40 years until we hit COVID. Then it dropped too low, which now it's coming back up. It'll probably go up higher than the line, then it'll settle into the line. But if you follow that line, 7 more years roughly, you get to zero. And that's a lot of history that says we're heading for 40 years. So then let's look at the industries themselves. First of all, insurance. Life insurance companies have long-term liabilities because they have to pay out death benefits in the end. So they have to earn money on their portfolios over the long term to be able to pay those basically debts out when they're due. P&C companies have a different problem, property and casualty. It's not so much interest rates I'm worried about there because they can charge what they want, but it's likely that we're going to have driverless cars in the future, maybe 10 years, whatever. But if I'm getting an interest dividend of 2 or 3%, I'm not getting my money back in the next 10 years. And that's the way I look at it. So, but the problem is with driverless cars, premiums are probably, for those driverless cars, almost going to zero because they're so accident free. But also, as driverless cars increase, even those who are still behind a wheel will have less accidents because those driverless cars will not cause as many accidents. So it's going to be a very negative trend for the P&C business. Then we get into the banks, more complex than the insurance companies. But with banks, they have long-term assets in the form of mortgages that they've issued. They have liabilities in terms of deposits, and then they have investment portfolios. So different rates help them and hurt them in different ways. It's a little more complex, but in general, it's been accepted that when rates go up, it's good for banks. So you'll see bank stocks go up when rates go up. When rates go down, bank stocks don't do so well. So that is the way I would generally view it. And rates, as I said, are forecast in my mind to go to zero. So that's not probably going to be very good for the banks' portfolios. And also, I'm very concerned about, or concerned anyway, about the office market. Occupancy right now in the United States is around 50%. Around the world, it's very similar. You have a lot of vacant office space. This could be the black swan, by the way, that also causes a recession if the Fed raising rates doesn't. Something probably will. But with rates, vacancies around 50% and occupancy around 50%, more and more leases are coming due. So just in the last month alone, the default rate on office buildings went up 0.25%. Now that doesn't sound like a lot, but that's just for the month, to 1.83%. So that's a pretty big jump to 1.83%. But this is the trend that's going to continue. Some people, office buildings are not going to be able to pay their debts if they don't have tenants, and rents are going down. And also, by the way, this is why I would avoid not only the office market, but also certain REITs, medical REITs, non-hospital particularly, off medical offices, or in storage too. Those office buildings are going to have to be converted to something, residential, storage, whatever they can do. There's going to be a lot of desperate situations. So we opened up the panel, which is Kim today. Nick's on vacation today. And so does it make sense at all to invest in banks and insurance companies, Kim?
So I think in the past, it always felt comfortable until just recently, but banks had always been quote unquote recession or considered recession proof. They've had a long history of being good for some investors to invest in for long term. They were really good stocks to invest in. But, I'm feeling a little uneasy, and maybe you can shed some light and change my mind. But I just don't feel like anything's a good investment in this day and time.
Yeah, well, it's a tough environment right now. So to sum
Yes.
this up, and I'll answer that question, but you're right. It's a tough environment. And the market shows it. If you're in the market, a lot of people were hurt in the last year, but it could get much worse. It probably will. So first of all, I would personally stay away from most or all insurance companies, but unless they didn't have exposure to P&C, property and casualty, and auto, particularly, because I look down the road and say, where is this industry going? I would stay away from banks too, because I see a lot of risk with interest rates, with offices. And you know what? If there wasn't alternatives, I'd say, okay, sure, I'll go for banks. I'll go for insurance companies. But there are alternatives. So you can look at, first of all, energy stocks as an alternative. You can look at safer businesses within different sectors. There's so many sectors. So I tried to pick out where am I recommending, but I have stocks in a lot of different sectors, food, energy, packaging, and a lot of other, oddball kind of things. But finding those stocks with good cash flows that can survive higher rates and probably increase their dividends or have very high yields, it's very tough, but there's lots of sectors. But I can't find any within those sectors because the sectors themselves are swimming upstream very likely. So you're right, Kim. It's a very hard environment to pick. That's why, right now I'm 65% bonds and cash. I'm willing to go long-term with part of my portfolio because, again, if I view that rates are going to zero in 7 years as a possibility, I want to have some of my money in 20 and 30-year treasuries or as long in state munis. But you can only get the munis I like are GOs but from certain states, but you can only go 7 or 8 years. So I use treasuries to go very long. Munis and energy is the one sector I think is going to boom, and you can get much more return. So we're running out of time because we're at the hour. But thanks for visiting with us this week, and we'll see you next week. As Kim always says, get healthy and get wealthy. And so we'll see you next Thursday, hopefully, on podtv.tv and all the other distribution channels, including Roku and Facebook. See you soon. Bye-bye.